All right. Good morning, guys. Good morning, everyone. So, welcome to a breakdown. Yesterday, the US dollar crashed. Should I call it a crash? There was a big drop. Okay, there was a big drop on the US dollar yesterday, and at the point where the dollar was dropping, I was like, okay, what is going on? Because we just came back from an FOMC decision that the Federal Reserve was hawkish more than they have ever been. So what in the name of markets juju is happening at the moment? I was really shocked because I was like, what is going on? I was pretty shocked. I was like, what in the name of God is happening to the US dollar today? You get it? Yes. Now, let's move on to what happened yesterday, July 30th. I mean, if you're a beginner and then you trade Japanese yen pairs, yesterday was not a good day for you, especially beginners who were caught on the bad side, on the wrong side of the market yesterday on Japanese yen currencies. It was not a good experience at all. Most of them might say this market is rigged. I'm not going to trade again. But like I always say, everything that happens in the market, there's a reason behind it. The market does not just move because it wants to move. There's always a reason for a particular move on the markets. And that is exactly what I try to do right here on my channel. I try to break down all these moves to help you as a CFD trader understand exactly what is happening. It guides you and makes your trading experience a successful one. So let's go straight into what happened yesterday. Okay. Now there was the carry trade, the intervention speculation, and all of those things that happened yesterday. So, like I said earlier, the Federal Reserve on the 29th, was extremely hawkish. You get it. They were hawkish from the FOMC. So everyone who was reading the dollar knew that dollar was supposed to strengthen, even though there was a sharp pullback on the day of the FOMC. I just knew it was just the market just shaking off weak hands. Then the next day, which was the 30th, the dollar now decides to drop extensively. I was like, okay, this no longer looks like shaking off weak hands. This looks like there's something actually driving it. So I sat down to understand what was going on at that particular point in time. And like I said, if you were short on GBP USD and Euro USD yesterday, and you didn't have stop losses in place, yesterday would have been one of those days where you feel like the market is going against you for no particular reason. But here are the reasons I found. And yes, if you want to read what I'm reading, what I'm going to share with you guys, you can go on www.sogcap.com, go on the blog section, and you can read every blog I post. I write articles out there. I make the markets very, very easy for you to understand. And you can also subscribe to our macro policy tracker, which currently tracks the US economy and breaks down every cycle, giving you a US dollar bias that makes the work really, really, really easy and smooth for you. So yesterday, there was a intervention speculation. Okay, I think the move happened because some traders somewhere felt like the Bank of Japan was about to step into the markets to defend their currency because the Japanese yen has been weak for a very long time. And so when they saw what was going to potentially happen, they decided to position themselves prior into the speculated intervention by the Bank of Japan. But one thing that caught my attention was if this truly was the Bank of Japan stepping into the markets, then the the Japanese stock market should have also come down as the currency was going higher. But you'd realize that as the Japanese yen was pushing higher, the stock market was also going higher, which actually made me realize that, oh, this was just a speculation. This is not really the Bank of Japan stepping into the markets, because um a real Ministry of Finance from the Japanese, colony stepping into the market would have crashed Japanese equities because a stronger yen will hurt export earnings. You get it? And that tells you that what happened yesterday was market-driven positioning, not an official government move. So, because after now, authorities from the Bank of Japan has also not come out to verify that they were the ones who stepped into the markets yesterday. So we can't for sure say it's them. And I feel like it was just a speculative move that happened yesterday. So now the number second thing or the second thing that happened yesterday that caused the dollar to weaken also was the US economy grew slower than expected. Now the Q2 GDP which is the measure of how fast the US economy grew between April and June, came in at 1.5%. Okay. Economists had forecasted 2.1%, so it came in lower than expected. That makes raise the question in the market's mind. If the economy is slowing, how long can the Fed really keep rates this high? You get it? So doubts about the Fed weakens the dollar. And so that was one of the reasons why, part of the reasons why we saw the dollar drop heavy like that yesterday. Number three, a massive crowded trade started to unwind. Okay. Now, what does this mean? The yen carry trade. This has been a conversation in the financial world for a very, very, very long time. Every time you go on X, the financial markets aspect of X, you see everyone talking about the yen carry trade, and all of that. I feel yesterday, you know, there was an unwinding that happened because of the potential, idea that the Bank of Japan was about to step into the markets. So one of the biggest and most crowded trades in the world right now is a yen carry trade, and it started closing out positions rapidly. I think yesterday on July 30th, they have been closing out positionings, but I think yesterday was one of those days that some traders actually closed some positions as of yesterday. Now, when these trades unwinds, it creates huge demand for the yen and selling pressure on the dollar simultaneously. More on all of these things below. That's why you have to go read the whole blog to understand. I'm just doing like a quick summary for what I've written on the blog. So what is the carry trade and why does it matter so much? So let me give you guys a simple analogy. Imagine you can borrow money from a bank in Japan at 1% interest per year. Now you take that money, you convert into the US dollar, and you put that money into US investments earning 4% per year. So you pocket a difference of 3%. That's like free money. All right, that is the carry trade. You borrow cheap in Japan because Japanese interest rate at the moment is really, 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 really low. Okay, I think at the point it was even at 0 point something percent. So if it's that low, you can go borrow from there because the borrowing cost is really, really low. Borrow from Japan, convert it to the US dollar, invest in the US at a 4% per year, back like that 3%, come back and pay whatever you have to pay. That's like good money. You get it? So that's basically what the carry trade is. Now, this trade has been running for years, and by July 2026, it had become enormous. Like the positions had become huge. The yen had fallen to its weakest level against the dollar in nearly 40 years, around 162 to 153 yen per dollar. The weaker the yen got, the more profitable the trade became. So more and more traders piled in, borrowing yen and buying dollars, borrowing yen and buying dollars. Now, that is why the word crowded matters so much. When a trade gets this much crowded, when almost everyone is on the same side, the exit becomes like extremely dangerous because if something spooks the market, like when small, everyone tries to leave at the same time. There is not enough room to get out without causing a crash. So I think that was one of the reasons that the yen spiked heavily yesterday and the dollar dropped heavily yesterday as well. Now, why did the carry trade unwind on July 30th specifically? The carry trade works as long as two things stay true. So the carry trade would be in motion as long as two things are correct. Japan continues to keep their rates low and the US continues to keep their rates high. Now, the moment either of these two looks like it's about to change, the trade will start to break down. So yesterday, both sides got hit at once. On the Japanese side, the Bank of Japan has been slowly raising its interest rate this year. Japan's rate is now around 1%. All right, that might sound tiny compared to the US rate of 3.5 to 3.75. But for a country that kept rates at zero for decades, it's a meaningful shift. You get it? Now, every time the Bank of Japan raises rates, borrowing yen gets more expensive and the carry trade gets less profitable. You understand? So, on top of that, speculation was running hot that Japanese Ministry of Finance was about to intervene directly in the currency market, spending foreign reserves to buy yen and force the dollar lower. No official confirmation of an intervention has been issued yet, but here is the key insight. Traders do not wait for confirmation. You get it? The market does not wait for confirmation. Market runs on what is about to potentially happen, not what has already happened. So when intervention looks likely enough, when the market feels like, okay, they might be stepping into the markets like anytime soon, traders will position themselves ahead of time. You understand? They would front run it, buying the yen before the Ministry of Finance from Japan supposedly does. All right, that positioning move alone is enough to cause significant yen strength. And there is an important clue that confirms this was market positioning rather than an actual government intervention. Japanese stocks rallied on July 30th. That matters because a real Ministry of Finance intervention, which forces the yen sharply higher, is typically terrible for Japanese equities. Companies like Toyota and Sony earn most of their money overseas and bring it back as yen. So a stronger yen means those earnings are worth less. You get it? When the Ministry of Finance has intervened in the past, the nickel has fallen. The Japanese stock market mostly falls when they intervene. The fact that it rose on July 30th tells me that the market was buying Japan broadly, not reacting to a forced official move. Now, on the US side, the GDP miss added fuel. Okay, US Q2 growth came in at 1.5% against 2.1% forecast. Now, that raised a question in the market's mind. If the US economy is slowing, can the Fed really keep hiking? You get it. Now, the three hawks who dissented, you have to go read the FOMC article I released or the video I dropped about the FOMC so you understand some of these things. I really did a good breakdown on there. So the three hawks who dissented on July 29th are going to have a hard time convincing the other nine members if growth keeps decelerating. So during the FOMC meeting or from the FOMC statement that the Fed released, there were three of the Fed officials who actually wanted the Fed to raise rates like for this particular for the July 29th FOMC meeting. They wanted the Fed to raise rates. But if GDP came in lower, 1.5% as against the 2.1% that was expected. Now, those three Fed officials will now have a hard time convincing the other nine members who said they should keep the rates at where they are. They would have a hard time convincing them to hike rates because GDP, like the overall economy, is not really looking good at the moment. You get it? So that doubt is dollar negative. It's bearish for the dollar. And so market took advantage of that particular situation and they sold the dollar as well. So when carry trade holders saw all of these signals converge, the Bank of Japan rates tightening trajectory, intervention speculation in the air, and the US growth miss, they made a rational decision, reduce exposure. Closing the position meant selling dollars and buying yen back, which is exactly what pushed the dollar lower on July 30th. You get it? Yep. So this was basically what happened yesterday. This was basically, in a nutshell, what happened yesterday. Go read the whole analysis on the blog, and you get like really, really deep into it. Okay, yeah. All right. So I'm going to end it here. So I mean, if you were short GBP USD yesterday, I'm sure the market took out your stops depending on what your stop losses were. If your stop was hit, I mean that is exactly what a stop loss is meant to do to cut your risk in terms of uncertainties. So don't bash yourself too much. It's one of those things, But a move this sharp and this sudden is precisely why stop losses exist. You get it? Yeah. Now, if you stayed in the trade, the question to ask is whether the fundamental reason you took the trade has changed or not. Well, for me, I'm still bullish the dollar and I'm still bearish GBP USD and Euro USD. Nothing has really changed for me yet. I might switch to the charts to show you guys, what I'm looking at after this particular drop and what I'm expecting to see going into the end of July. Because today is July 31st. So I want to see certain things confirmed. That will give me the understanding of what to do going into August and going into, next month. Yep. So yeah, you can go on the web app www.sogcap.com and go read. Like I said, this was a breakdown. I just wanted to get you guys up to speed on what was happening so most of you understand why the crash happened, and it is what it is. Stay safe. Peace. Hey, wait, I said I was going to switch to the chart. Okay, let me quickly switch to the chart and show you guys exactly what I'm looking at on the DXY. Give me a moment. All right, so this is the DXY. This is the dollar index. This is the aftermath of the crash. This is what happened yesterday. This is what happened yesterday. Um, uh, it's been terrible. Let me put it that way. It's not been exciting at all. But then let me go on the weekly time frame. Like I always tell you guys, the weekly time frame is my go-to time frame. You can see I have a level marked here. This is the most recent low on the dollar index. Yep. And so far as the week, we end the week closing above this particular low, which is around 100.345 on the dollar index. Yep, my bullish status on the technical side is still intact. Of course, I am bullish the dollar from a fundamental and macro perspective. But like I always tell you guys, the macro and the technical needs to line up for you to get the kind of moves you want to get. So what I'm looking at, I'm looking forward to um before the week ends is to see the US dollar, the dollar index close above 100.345. If the dollar can close above 100.345, I am still bullish on the dollar index. Now, if that fails to happen and the dollar index, let's say, closes strongly below 100.345 before the week ends, then I would be a little bit cautious going into next week, God willing, because now it will mean my macro is saying bullish, but my technical is saying bearish. So I'll be extra careful going into next week, God willing. But if I see, so right now I'm still sitting on my hands. I'm still waiting to see how the week ends. If the week ends on hands I'm above 100.35, then I'm expecting the DXY to continue the move higher in the month of August. Okay, now let me switch to the 4-hour time frame, which is the intra-week direction. Now, at the moment, um, you can see it looks like I'm not saying it looks like we're about to get the the shift I normally tell you guys to wait for. If you want to buy, you want to wait for the 4-hour time frame within the week to line up with the weekly time frame. So there's one that I always tell people that if the weekly time frame is bullish, yeah, and the week has not ended for you to see a bearish shift on the weekly time frame, no matter how deep the market pulls back, don't ever say, oh, the market has shifted while the week has not ended. No, you have to wait for the week to end to now for the week to end and shift on the weekly time frame to now let you clearly understand that the week has ended. Same with the dollar index at the moment. So this is the last official low per the weekly time frame. Right, this is the last level of the weekly time frame. Now you can see clearly how the market has traded all the way below it. Now, for me, this is not a break of structure until the current weekly time frame candle closes below here, this particular price. If we end up with with the weekly time frame closing above this particular price, then it means the weekly is still bullish, and I'm still going to look at buying the US dollar going forward. But if that shifts, if the weekly closes, way below, let's say it ends up rolling over and closes way below 100.345, then that tells me that my technical direction is bearish and my macro is bullish. Now, there are times when the technical can go against the macro. It happens sometimes. It happens sometimes. But mostly when it happens like that, I am extremely careful with the kind of sizing I put on the markets. You get it? I like it when I'm trading and the macro is lined up with the technical. But if there is a shift, I am extremely careful. Yes. So as of now, like I said, I'm still bullish the dollar index, no matter the drop, no matter this particular drop. I am still extremely bullish on the dollar, especially from a macro perspective. So I am looking forward to see the technical also shift, give us a nice confirmation. Now, I'm pretty sure it could potentially happen that the 4-hour would give us, that W pattern and the confirmation. Like I always say, not every change of structure means the market has shifted. Wait for your confirmation. When the confirmation happens, that is when it tells you that, okay, the market has actually shifted, and then you continue buying. Because sometimes you can get a change of structure, then the market will obviously roll over. That tells you that that shift or change of structure you saw was not a change of structure, but it was the market just probably tapping into liquidity or something, whatever you guys call it. Yes. So as of now, I am still bullish until the week ends. I am still buying the dollar. I am not selling the dollar because of this particular drop. Yep, I'm not selling the dollar because of this particular drop. I am still buyer on the US dollar, and I'm anticipating that the DXY will close, above 100.345. That is the level I'm watching going into the end of the week. All right, guys. So this is where I'll end this particular video. Stay safe. Don't forget to subscribe. All right. And don't forget to share this video with your friends and family so they can come and listen to the good deals that I put on here. Stay safe. Peace out.